Caution was the watchword of the day on Wall Street today. Investors focused their attention on President Obama's plan to combat Islamic terrorists in the Middle East, some tougher new sanctions against Russia, and the timing of the Federal Reserve's next move on interest rates ahead of next week's policy meeting. The major stock averages began the day lower but closed at the highs of the session, getting a boost from rising oil prices. By the closing bell, the Dow lost 19 points, the Nasdaq was up by 5, and the S&P added 1 point. Well, despite investor caution and uncertainty, there's been one consistent trend in recent weeks. Every time the major averages pull back from their recent highs, many investors have stepped back in to buy. Dominic Chu looks at the recent market activity, what may happen next, and what some professionals are buying right now.
Stocks go up and stocks go down. But with the overall market still near record highs, many investors are wondering if now is the time to sell and take some of those profits off the table. Certain stocks are getting hit worse than others. So far in September, the broader S&P 500 has lost about 0.5%. But energy stocks have taken a bigger hit. As a sector, it's lost around 4% during the same time. One big reason is the price of oil. It's been on a steady drop since June, and that's helped drag down oil-related stocks. But not everyone is as worried about oil.
Main Street should not be looking at the price of crude oil and determining what their energy investment should be. They should be picking solid energy companies with a focus on the growth in U.S. Oil production, which is at 45-year highs. Who are the winners? Who's got the proven assets? Invest in those businesses.
Among Terra Nova's top picks are oil and gas exploration and production companies like EOG Resources, Pioneer Natural Resources, and Marathon Oil. So far in 2014, there have been 3 notable pullbacks in the stock market, but none have been more than 6%, and each bounce has led to fresh highs. Some experts believe that the trend could continue.
Consumer sentiment is as high as it's been since before the recession. Auto sales have spiked, manufacturing is picking up, and we're seeing that information out there, yet the market's kind of plodding along right now. So I think a lot of the optimism has been priced in. Nonetheless, the economic backdrop looks good. So I think we're going to see stocks continue to move higher, but I wouldn't expect anything dramatic.
Of course, geopolitical and economic risks still abound, and some market pessimists still maintain that we're long overdue for a significant stock market correction. For Nightly Business Report, I'm Dominic Chu.
So far, September has been a bit of a languid month for stocks. They ease down a bit, and as Dom said, then they wander a little bit higher. Nothing in their behavior this month has screamed buy or sell. Even money manager Mike Holland sounded tentative when he told us yesterday what he's been doing with his portfolio.
I've still got a very full equity portfolio, but I'm taking some chips off the table. And when in 2008, when things were very ugly, as Warren Buffett said, that's when you buy some things. So right now, I'm actually paring back. I'm not selling willy-nilly, but in fact, I've taken a few things off the table just in the last several days.
So how does an individual investor know when it's time to do what Mike Holland is doing? Judiciously selling shares. For some signposts, we turn to Mitch Goldberg, president of his own investment firm, Client First Strategy. Mitch, welcome. Good to have you with us.
Thank you for having me.
You know, we in financial news on television, we are very partial to telling people exactly what to buy. Tell me what to buy, and I get it. We're probably less good at telling people what and when to sell. What's your best advice for them?
My best advice is investors need more discipline, because you're right. People are always focusing on what to buy. Research is buy-driven. But as investors, we need to take some chips off the table. As they say, don't count your chickens until the eggs hatch. So, don't count your profits until you take something off the table. My feeling is that with a disciplined strategy, I like to use strategies like stop orders, trailing stop orders. But basically, I want it pre-programmed so that when my stocks go up a certain amount, let's say you have 1,000 shares of a stock, it's up 25%. I want to take 25% of my shares off the table and reinvest the proceeds.
So you take the emotion out of it, basically.
As much as possible.
Mm-hmm. And, you have some tips. We have them up on our screen, so let's go over some of them. You say hesitation is the costliest enemy from investors. Is that to the emotion thing that Tyler was just talking about, or something else?
No, it goes directly to the heart of what Tyler was talking about. When you have hesitation, it's a symptom of a lack of a disciplined strategy. So what we want to do is we want to bring in the discipline to avoid having to, let's say, be in a stock that's up. You ride it up, you ride it down, you ride it up, and then at the end of the day, you really haven't made anything on your
So are
equity
you
position.
saying the day that I buy the stock, I pay $20 for a stock, and that day I should say, and when it hits 40 or 50 or whatever it is, I'm going to sell it? Is that the discipline?
It's somewhat similar. There is a little bit of feel to this also
Okay.
because it depends on industry, volatility, different stocks, different news coming out. But typically, if I'm up 25% in a stock or so, that's where I'm going to look to put a stop order just below that level.
So you say don't sell all at once. That's the other point here.
Thank
In other
you.
words, if the stock has gone up 25%, you might not dump 100% of it. You might dump 25 or 50%. Similarly, if let's say I bought a stock, for argument's sake, or an ETF at $100 a share, I ought to have in my head the point at which I am going to start aggressively selling on the downside, right?
Yes.
Is it only price-driven here, or do I want to watch developments in the news if I hear that an earnings number isn't good or that there's some sea change in an industry? Or are those kinds of day-to-day news factlets probably going to mislead you as much as they're going to help you?
I would say they're going to mislead you as much, if not more, because then what's happening is you're becoming so hyper-focused on the day-to-day news. You start buying, you start selling, but you're not really making any progress. You know, there is something called buying and giving investment some time and being patient. So if you're going to, let's say, buy a stock, for example, I'm not necessarily going to buy it all at once. I might put even, dare I say, a market order for 25% of a new position and put a buy limited order in for the same stock. You know, if it goes down 3%, I'll double up. If it goes down 6%, I'll buy a little bit more.
It's
maybe
a
down
buy
9%.
limit order.
Right.
It's an open order that basically says that you're willing to pay a specific price at a certain price or lower.
Mitch, I was really interested on this last tip that you have for our viewers. You're saying raising cash is not a long-term strategy. How do you know how much cash you should have in your portfolio?
It's a good question. I think generally it speaks to people's risk tolerance, their time horizon, their financial goals. But if somebody is, let's say, 70 plus, retired, I'm actually looking to be maybe 40 to 50%
That much?
cash and fixed income. I am. Things can change a little bit, but right off the bat, at this level of the market, that's where I'm comfortable for my clients. Again, everyone's situation is different. Somebody in their 40s or 50s, we're probably talking 10 to 15% cash.
So I think we began very quickly. We began by saying you're taking a few chips off the table. Where? What kinds of stocks? And what are the characteristics of the ones you're selling?
Well, the characteristics of the ones that I am mostly selling are actually my winners. And they are across the gamut, from industrials to consumer discretion, consumer staples, healthcare, energy.
Well, I'm glad to hear you
et
have winners across the gamut. That's a good thing.
Well, you know,
in your business.
The idea is to thank you very much. Yes, we have our share of bruises also. Okay.
All right. So you're selling the winners, not the losers.
Right,
mostly
but
at this point.
it's a gradual process of coming out of old positions gradually on the way up.
Yep.
And taking on new positions on the way down. So it's always a seesaw between
Okay.
cash and equity.
Well,
Mitch,
that's
thank you very much.
fascinating.
Mitch Goldberg of Client First Strategy.
Thank you
Thanks
for
again.
having me.